So we've now had the Reserve Bank of Australia on hold for 10 consecutive meetings, the most recent one being yesterday, Tuesday the 5th of April. The record period of time for the Reserve Bank of Australia to be on hold with monetary policy is 17 meetings. That was between 1995 and 96. We feel there's a good probability that that record might be tested in the current environment. So in other words, there is a period we feel for monetary policy to effectively be on hold. So what does that mean for bond investors? Well, we've got the Australian 10-year bond yield tracking at around 2.5%. Now, if we consider inflation that's running more or less at around 2% in our economy, if you factor in growth that's somewhere between 2.5%, maybe a bit higher at the moment, you're looking at nominal growth of around 4.5%. With an Australian 10-year bond at 2.5%, we feel that presents very poor value indeed for investors, providing a return barely above inflation. So what are the drivers for Australian bond markets given those factors? Clearly the global forces at play with the gravitational pull lower in bond yields is a major one. We've got Japan with negative interest rates, we've got Europe with negative interest rates, we've got the US Federal Reserve with still what we feel to be excessively accommodative policy given the circumstances over there. All these are conspiring to keep our market at the higher end of valuations relative to what we think long-term value should be. So the risks, in our opinion, are that as those forces start to abate, and particularly as we do see real signs of inflation coming to the surface in the United States, the risks are to higher bond yields. And so we're very mindful of that in our local context. Certainly wage growth is very low at the moment. The wage price index is tracking at around its lowest level for quite a long time. And that just is one of many challenges that the Australian economy faces. However, we don't feel that the Australian economy is in particular dire straits at this stage, which is one of the reasons why the Reserve Bank continues to be on hold. So yes, wages are low. They're barely keeping pace with inflation. Household debt remains very high. Fiscal policy continues to be something that is very constrained in terms of its ability to add stimulus to the economy. So there are headwinds here that are not uncommon with many other advanced economies around the world. Having said that, we have unemployment that's below 6%, we have economic growth, we have inflation that's tracking along at an okay pace. And so there are signs that the Australian economy remains reasonably healthy, albeit with a pace of growth that's at the lower end of what policymakers would like to see. I think it's very insightful that even in 2016 so far, the news flow out of China has been a dominant force influencing the direction of financial markets. And I think that signifies the fact that China is now a significant component of our world economy and will continue to be over the coming century at least. And Australia is not immune from that. So I think with the steadying down of commodity prices, with the decline in commodity prices, that's certainly taken some of the wind out of the sails of a key driver of our growth here in Australia. But it's very clear that services, tourism, education, financial services is something that Australia can benefit from very heavily. And so I suspect that as we kind of move from the old style of growth, mining, investment related, to more steady state consumption-driven growth out of China, it's still going to be very influential what happens in China for our economy, but in a very beneficial way.